Hi, everyone. Paige Manzarello here, the Cash Flow Chick. And we're going to talk today about mortgages versus deeds of trust. You're going to hear those terms as you go into notes and note investing. You also should be hearing those terms if you're buying any kind of house. A mortgage and a deed of trust are essentially the same document, okay? It just depends on the state and whether it is a judicial foreclosure state versus a non-judicial foreclosure state in terms of being referred to as a mortgage or a deed of trust. For instance, in California, where I live, California is a non-judicial foreclosure state, and our documents are called deeds of trust, okay? In Ohio is a judicial foreclosure state, and so that particular document is referred to as a mortgage. Those two documents are essentially the same thing. They just have different titles based on the state, okay? So you ask, what is a mortgage or a deed of trust? It is a document that binds and ties the promise to pay to the collateral, okay? So it's not just, you're going to hear mortgages and deeds of trust in note investing, but you could also hear those same things in investing in car loans, because the car is the collateral for the promise to pay, okay? As you all know, I invest in real estate notes. So I invest in notes that are secured by a building, by either a house or a commercial building, okay? And how I tie the collateral to the promise to pay is through a document called a mortgage or a deed of trust. So when you go to the bank and you get a loan to buy your house, you're going to be signing two different documents. One is the promissory note, okay? That is an unrecorded document. It will list out all of the terms that you have agreed to repay the bank. So it will give you the interest rate, the length of time, meaning 15 years, 30 years, etc. It will give you your monthly principal and interest payment, also known as a P&I payment. So it will list that as well. Your interest rate, I think I said that already, and the term and who your lender is, etc. So that's the promise to pay. The mortgage or the deed of trust, also known as trust deeds, that document is the document that secures the bank's position. It's the document that ties the collateral, the house or the building, to your promise to pay. That document is the document that allows the bank to take your house if you stop paying on your mortgage, okay? So in note investing, it is essential that you have both the promise to pay, the unrecorded, which is an unrecorded document, and the mortgage or the deed of trust, which is a recorded document that is recorded in the county where the collateral sits. So if your house is in California, in Los Angeles County, then that mortgage or that deed of trust, because we're non-judicial, right? So that deed of trust is recorded in the county recorder's office in Los Angeles, all right? But it is essential as a note investor that you have both of those documents, and those are collectively referred to as notes, okay? Even though one is technically the note or the promissory note, the promise to pay, and the other is what attaches the promise to pay to the collateral, which is the mortgage or the deed of trust. But collectively, we call those notes and note investing. But it is essential that you have those two documents. If you have a promissory note, but you do not have a mortgage or a deed of trust, your promissory note is unsecured. That means that there is not a document, there's nothing that is attaching that promise to pay to anything. Okay, so if you are a private lender and you are lending to somebody to fix and flip a property, be sure that not only do you have the promissory note, but you have the mortgage or the deed of trust to attach that promise to pay to the house, the collateral. If you don't, and your borrower stops paying you, you essentially have to take them to court and file a lawsuit against them in the hope that they can pay, right? And that they will pay. If you have secured your position, meaning you've secured that promissory note with collateral via a mortgage or a deed of trust, now you can just go to whatever foreclosure process is in your state, whether that's a non-judicial process or a judicial process, and foreclose on the house to recoup your funds. So mortgage and deed of trust, or AKA trust deeds, essentially the same document, but both, but they are essential to have both the promissory note and either a mortgage or a deed of trust to attach that promise to pay to the collateral. So if your borrower stops paying, you have something to go after. You have security in your investment. I hope you find that helpful. Check out my other videos on my YouTube channel or Facebook or Instagram. Of course, it's at Cashflow Chick, and Instagram at the Cashflow Chick. I look forward to seeing you next time. Thanks, everyone.